To this part 2 of the two-part series of this option basics tutorial. It's mainly targeted towards beginners. Actually, it is targeted towards beginners. In fact, thanks for all the feedback from the part 1. I realized that last time we digressed a bit. So this time we are going to remain very focused, and let me share my screen and start the presentation. All right, you guys can see my screen?
Yep.
Awesome. Okay, all right. These adjustments. Okay, so this is our agenda for today. We are going to start with a short summary of the concepts covered in part 1. I think most of you would have attended part 1, and some of you might have watched the replays. So we will quickly summarize the concept. And today it's only going to be about put options. So we are going to explain the structure of the option with reference to a put option. We are going to talk about the benefits of buying a put option, the disadvantages of buying a put option. We are going to see what selling a put option means. I mean, we have mostly been talking about buying options so far. We will also see what selling a put option means. How a selling can hurt us, selling an option can hurt us when it is done wrong. And unfortunately, a lot of people, in fact, I would say majority of the people who sell options do it wrong because they don't keep an eye on the risks. Then I'm going to explain the end-to-end strategy of why and how we sell put options in MoneyWise Smart and how we benefit from them while keeping an eye on the risk. And I'm then going to, and this is especially for the people who have never ever bought or sold an option, I'm going to actually demonstrate by putting in a trade. I think right now it's 8:05, so at about an hour and a half, the markets will open. So I will actually put in a trade and show you how an option is done. So that's basically how we are going to start. And before we dive in, can I just request you guys to type and let me know what is the first question that we ask ourselves before we enter into an option position, so let's see if anyone remembers. That is the first question which we had discussed. Okay, Vaibhav gets it. How much will I lose, or what if I'm wrong? You know, basically, we need to always keep an eye on the worst case scenario while doing an option position, for the very simple reason that options are leveraged instruments and a lot can go wrong. And by the way, for those of you who are on our existing subscribers or the investment fundamentals and option series group, there is a very interesting post that Kelvin Saw had posted about how a guy, he thought he had a risk of just a few $100s, but he wakes up on Monday morning to see he lost $30,000. So I would highly encourage you to go and watch that. Anyway, let's dive in. So the value of an option comes from the ability to buy or sell shares of stock at the strike price of an option by a certain date. So we already discussed this. And in the part 1, we saw that all options, they have an underlying security or an instrument. We mostly deal with stock options, but there can be options on futures, there can be options on currencies. Then all options come with a right to either purchase or sell. The right to purchase is a call option and the right to sell is a put option, which we are going to discuss today. All options come with an expiry date. In fact, you can think of a stock as an option which has no expiry date. So I look at any stock as a $0 strike call option with no expiry date. All options come with a strike price. So that is the price at which I can either buy in case of a call option or I can sell in case of a put option. All options have a multiplier. Majority of the stock options which we look at have a multiplier of 100, the ones which are listed in the US, but there's no hard and fast rule. Options listed in other markets can have a different multiplier. And for a particular underlying price, an option comes with a premium. So just like to buy an insurance policy, you need to pay a premium. Similarly, to buy an option, you need to pay a premium. And as part of the structure of the option contract, which is for a particular underlying price, the premium has an intrinsic value. It can be 0 or higher than 0. So we will see that. And then there are certain market components of an option. Like we have the bid-ask spread. You know, an option, the option holder or the owner of the option. By the way, I understand there's some confusion about who is the holder, who is the owner. It's all the same. Whoever owns the option, whoever has purchased the option, I refer to them interchangeably as the option owner or the option holder. So while the option holder can exercise the option is also tradable in the market. So for that, you have a bid-ask spread. Then we discussed about the open interest, we discussed about volumes, and we discussed about the extrinsic value component of the premium. And we will go into depth further. And then we also touched upon the implied volatility. It's outside the scope of today's session, but that's a very important component of an option. And we have dealt with this extensively in our option series videos. Okay, so a put option is the right to sell 100 shares or any underlying security at a certain strike price on or before the expiry date of the option. So here we are talking of one contract of a put option. So one contract controls 100 shares, as we have seen when we discussed the multiplier. Now, the value of a put option comes from the ability to sell shares of stock at the strike price of the option by a certain date. This is just kind of a recap. So lower the current stock price, the higher the value of the put option for any strike price will be. So isn't it good to have an instrument where the price actually increases when the stock markets crash? So that is what a put option is. When the stock markets crash, the value of the put options go up. The value, the market price, everything goes up. Now, if the stock price decreases, the value of the put is expected to go up, and often very significantly, because remember, these are leveraged instruments. So one contract controls 100 shares. However, by the expiry of the put, if the share price is above the put option strike price, then the put option will expire worthless. Now, the options can be traded in the market just like stocks. But the market price of an option, and this is the important thing to understand, the market price of an option must always include the benefit or the profit it can provide the owner if the owner were to exercise the option right away. And we will exactly see what that means. So what if you owned a put option on Tesla at strike 500, which means that you have the right to sell Tesla stocks at 500. And let's assume the Tesla share price currently is 442. Now, you find that the price of the put option in the market, your brokerage platform is showing the price and it is showing it as $50. Is that possible? Can someone just type and let me know if you think that is possible? Just do a quick calculation. And this is, I'm asking mostly the beginners, the newbies. Anyone? Okay, no problem. I haven't got any response, so let me explain this. Now, imagine if the Tesla share price is 442. So let's assume you own Tesla, or maybe you do not, but you have the right to sell the Tesla stock for 500, which is $58 higher than what the current share price is. So isn't that valuable? Just imagine, you can just buy, a few shares of Tesla from the market, and you can sell those shares immediately using the rights that have come with your put option for 500, and immediately you make a $58 profit. So that's the reason, if I find that there is a put option which gives me this right, then I will immediately go and buy this put option, because this put option is available only for $50, but I can buy this put option and immediately make $58. So just like me, everybody else in the market who is watching this and who understands what the value of this put option should at least be, they will immediately go and start buying this put option. And till the point of time, the price of the put option, it's demand and supply. So the price of the put option will keep rising till it crosses 58. So at least, then the put option will include the basic value which it comes with, which is the ability to make a profit of $58 immediately. So let's take an example, and then this will become clearer. So CCL is the ticker code of this company called Carnival Cruises. And let's go back in time to 14th of February. Now, that is the time when the COVID virus had just started spreading outside China. And you can see in the last few days, the stock price had come down slightly, but it was still at 42.60. I think at its peak, it was above 50. So if someone who was smart enough, I'm not as smart, but if someone was smart enough to think that, what, if this COVID virus spreads, then maybe Carnival Cruises can face serious problems. And let me go and buy a put option, because as we have already seen, that if the stock price drops, the value of the put option will go up. So let's look at the put option prices at this point of time. By the way, I'm seeing some of your questions, but today I will deal with all the questions during the Q&A session, which is right at the end. So that way we won't get distracted. So this is this is how the put option prices look like. So Carnival Cruises is currently trading on 14th of February at 42.6, and we are considering the 40 strike put. Now that is currently available in the market to purchase at $4.40 per contract. The bid is $4.30, which means, if I own that put, if I want to sell, I will get $4.30. But if I want to buy that put option, I will have to put up $4.40 per contract. But one contract controls 100 shares. So I will basically have to shell out $440 for one contract. And this will give me the right to sell Carnival Cruises at 40. So just imagine if I own Carnival Cruises shares, this is like insuring myself. So even if the COVID situation becomes really bad, now, Rim, on 14th of February, I still don't know how bad the COVID situation is going to be. So even if the COVID situation gets really bad, I still have the right to sell Carnival at 40. So I'm not too worried, even if the share price drops to 20. So let's see what happens. Now, I decide to buy 10 contracts of this 40 strike put for $4.40, which means for 10 contracts, I spend $4.40 multiplied by 100, that is 440 per contract, multiplied by 10 contracts, which is $4,400. So $4,400 is what I spent in purchasing this put option, or it's kind of an insurance policy. And that is the maximum amount that I can lose. Okay, so what can possibly happen? Let's say the COVID situation does not get worse and Carnival Corporation share price goes up. So if that happens, then the maximum loss is $4,400. However, if Carnival Corporation share price drops below 40, see, this is the 40 point. If it drops below 40, by the way, the y-axis is the profit. So I'm still at a loss zone till I recoup the premium which I paid for purchasing the put, which is $4.40. So once I recoup that, which means my break-even point is $40, which is the strike price of the put. That is my right to sell the stock. And I have spent $4.40. So 40 minus $4.40 is $35.60. So that is my break-even point. So anything below $35.60, I start making a profit for owning this put option. And if Carnival Corporation goes bankrupt, that is, it goes to zero, I still have my right to sell Carnival stock at 40, which means I will be selling this 10 multiplied by 100, that is 1,000 shares at $40. So I will bring in $40,000. But I purchased the put option for $4,400. So the balance, $35,600 is my profit, just because I had the foresight to own this put option, 40 strike put option. So that is the benefit of owning a put option, when we expect the markets to drop. However, there are caveats, and we will look at all those. Now here I have just flipped this picture. I like to look at it like this because that way I get to superimpose the stock chart on the left. So here you can see the stock price currently is this blue line, which is the close price is $42.60. This is the end of day of 14th of February. So this blue line is the stock price. My break even is 35.6. My put option strike is 40. So anything above 40, this is the maximum that I will lose, because this is the profit line and this is zero. So anything on left side of zero is my loss. So my maximum loss is $4,400, and here this is the profit that I make. So imagine what happens if the stock price just crashes. So put options can be used to hedge the decline in stock prices. And this can be quite a useful strategy if used properly to protect stock portfolio from market price corrections. Now, let's look at the price of an option. Now, as we discussed this earlier, the market price of an option should always be greater than or equal to the benefit the owner can get by exercising the option, which is basically the intrinsic value of the put option. Now, if not, then you realize that it will be suboptimal for the owner to accept the market price. Just like the Tesla example I gave, the intrinsic value of that option was $58. But if the market price is $50, and if I own that option, then I will be absolutely crazy to sell the option at $50. I would expect the people who want to buy to, pay me appropriate price, which should at least cover the intrinsic value that is there in that option, which is $58. And I will, of course, expect something more. So otherwise, it will be suboptimal for the owner to accept the market price. So option premium has two components. One is the intrinsic value, and the other is the time value or the extrinsic value. Now, what is the intrinsic value of the option? And I know that there is some confusion here. So let me just stop sharing the screen and give you an example which should help you guys to understand this. So you guys can see me, I guess, right? Now, this is my wallet. My wife had gifted this wallet to me, on my birthday. And if, let's say, I decide to sell this wallet, now, of course, this wallet is valuable to me because this is a gift. She went and picked it up. And if I want to sell it, this is a used wallet. And let's say if I put it up on Carousel or eBay or something like that. Yeah, there are some people who might put up a bid. For a lot of people, the value of this is zero. They may not be interested in buying it. Some people might put a bid for $5. Some people might put a bid for whatever, $100. Some people who understand that this is a Bottega Veneta wallet might, think that, what, this is a good buy because this model is not available in the market. So they might want to buy it. I personally, if I see something like this, I would not bother. I mean, it's a used wallet. Why would I bother buying it? So this wallet does not currently have any intrinsic value. The person who is looking at the ad for selling has no idea whether my wife bought it from the, from the showroom, Bottega Veneta showroom on Orchard Road, or whether she picked it up from Pagoda Street in Chinatown for $5. They don't know. You can't make out. So this wallet right now has absolutely no intrinsic value. What about now? Let's say I have $100 here with me. So what if I put this $100 inside the wallet, and what if I try to sell the wallet now? Now, do you think the people who earlier who were interested but just put in a bid of, let's say, $40 or $30, do you think it's quite reasonable for them to increase the bid to at least $100? Because if they don't, then I will not sell the wallet. It's as simple as that. So now suddenly this wallet has assumed an intrinsic value of $100. Even if I see a wallet with a guaranteed $100 inside it, even if I don't have any value for this, piece of leather, I know that, I can at least buy this wallet. If I can buy it for less than $100, I will definitely buy this. And if I have no value for the, empty wallet, I'll just take out the $100 and I'll just chuck the wallet. But that intrinsic value becomes mine. So the demand will be such that the market value now will be at least $100. And that is exactly what the intrinsic value of an option is. The moment I take out this $100, now what remains is just the extrinsic value. And the extrinsic value, just like this wallet, the extrinsic value of an option purely depends upon the demand and supply, So that is basically what the intrinsic value is and extrinsic value is. I hope this explanation is clear now. So I'll go and share the screen once again. Okay, so earlier we had seen that for a call option, the intrinsic value is equal to the share price minus the strike price of a call. But in case of a put option, the intrinsic value is the strike price of the put minus the share price. Because if I own the put, I have the right to sell the stock. So obviously the intrinsic value is whatever is the difference. So if the strike price is higher than the share price, then the put option has a positive intrinsic value. Whereas if the strike price is lower than the share price, then the put option has no intrinsic value. Just like that wallet. When there was no money inside the wallet had no intrinsic value at all. So in this example, we went back to 1st of April 2020, and here I'm looking at Facebook options, which are expiring on 19th of June 2020, and these are the put options. Now, Facebook currently, that is on 1st of April, Facebook closed at 159.60. So if I look at the 120 strike put options, you can immediately see that they have absolutely no intrinsic value, because, you know, why would the right to sell Facebook at 120 be of any value when the share price is close to 160? However, it still has some extrinsic value, and this extrinsic value derives from the market's expectation. So the market is expecting that maybe there is a slight possibility that the Facebook share price might drop in the next 79 days, which is leading up to the expiry of this option. It might drop and go below 120. That's the reason maybe some people are showing some demand for this particular option. That's why they are ready to buy it for, you know, $3.35. That is people who are bidding, and the people who are selling these options, you know, they also feel that there is some value because this offers some kind of a protection. So they are asking for $3.85. And the protection that these options offer is that for someone who owns the Facebook stock, let's call it $160, even if Facebook goes bankrupt, the maximum that this person will lose is just $40 and not the entire $160. So that is the protection which these put options offer, but they don't have any intrinsic value. However, if we go to the 175 strike put option, we can immediately calculate that they have an intrinsic value of 175 minus 159.6 is equal to 15.4. So they have $15.40 of intrinsic value, these options. However, now let's look at the extrinsic value. And before that, let me quickly draw your attention to the market price of these options. See, the intrinsic value is $15.40, but the market price is a lot higher. And we will see the reason for that. That's because of the extrinsic value. The extrinsic value of an option is the portion of the market price of the option that exceeds the intrinsic value. The extrinsic value is also known as the time value. So, you know, we will use this interchangeably. So you should understand that we are referring to that excess over and above the intrinsic value. And higher the extrinsic value of the option, higher is the potential of the option to become more valuable by the time it reaches expiry. Because, as I just mentioned, that the extrinsic value reflects the market's expectation of what's going to happen in future, you know. So because of that, you know, the demand, if the demand goes up, then the extrinsic value goes up. But the intrinsic value is only dependent on the strike price and the current share price. So the extrinsic value depends on demand and supply, as I've mentioned. So in this particular case, for the 175 strike option, we saw that $15.40 is the intrinsic value, and the extrinsic value is the premium minus intrinsic value, which is the extrinsic value of the bid is $6.60, and the extrinsic value of the ask is $7.70, which is exactly what is listed under this column, $6.60, $7.80. So that's the extrinsic value. And I had, sorry, I had showed you this picture while discussing call options, that the extrinsic value decays with time. So as an option nears the expiry date, this is how the time decay curve looks like. If the share price remains constant, the intrinsic value of an option will remain constant. Okay, but the extrinsic value will decay. Again, remember the wallet example. Over time, this wallet will become older and older, and maybe it'll get tattered. So there will be no extrinsic value left. At some point of time, I'll probably just throw it away or just keep it as a memory. But the intrinsic value will be because of how much money I have inside it. The same is the case here. So we have already seen that in this case, the extrinsic value is 660, 780. In this particular case, we have taken a closer to expiry, closer dated option. So this option expires on 15th of May, which is just 44 days to go. And here you can see for the same strike and the same share price, the extrinsic value is a lot lower. And this option expires just in 16 days. And you see the extrinsic value, in fact, the extrinsic value of the bid is, it's already decayed up. There is no extrinsic value. And the ask price has an extrinsic value of $2.20. And by the way, guys, I know I'm going very slowly today. This is intentional because this particular presentation is directed solely for the beginners. So the advanced people or the intermediate people, you can, please bear with me. And for the beginners, even if you don't follow a certain concept, don't worry. The video is going to be there. The recording is going to be there. Please go and rewatch the video. Let me tell you that today I'm going to cover a lot of stuff. There are some 80 slides. And for me, I was not very sharp when it comes to picking up options when I started using options. And all the concepts that I'm going to cover in today's presentation, it took me a total of about a year to fully internalize. So there's absolutely no problem if you don't fully understand. Go watch this video, rewatch this video. It completely depends upon how committed you are, because the light bulb moments will happen down the road. So give that a chance. Okay. So coming back to this, just 16 days to expiry, and each of these expiry options, as they move closer to their respective expiries, their extrinsic values will decay even further. Now here, notice what happened to the bid price. The bid price is now $15.10. Do you notice something unusual? Just some time back, we calculated the intrinsic value of this option is $15.40, whereas the bid price is $15.10. So just step back and think, guys. If I own this option, and let's say if I want to close my position, does it make sense for me to sell the option at market? Because if I sell it, I will only get $15.10. Whereas if I exercise my right, I will get $15.40. So let's see how that will happen. If we wish to sell this 175 strike put in the market, because the options, all these options strikes are trading in the market. And I'll show you when we go to the interactive brokers. They all have, the prices are constantly moving. But see, I'll only get $15.10. So for one contract, I will only get $1,510. Whereas instead, if we go and buy 100 shares from the market at the current market price, and if we immediately exercise this particular option, by the way, to buy these shares, we won't need to put up too much money if we already have these options, because the brokerage platform is aware that I have these options, and the brokerage platform knows that I have the right to exercise these options. So I can, with one click, I can purchase this option. I'll hardly need too much of margin, and in the next instant, I can exercise these options, which will sell these shares for 175. So we will make the intrinsic value of 175 minus 159.6, that is 15.4 per contract or $1,540 per contract. So see, I have made $30 more than just blindly going and selling these options in the market. And the reason I'm spending some time on this is because I know that majority of people who buy options, when they try to close the options, they blindly go and sell the options in the market without realizing that that is a suboptimal decision. I have discussed this, for a lot of you, you might think that I'm sounding like a broken record. I have had quizzes on this. We had extensive discussions on this. I remember Vaibhav had won that quiz and he provided extensive explanation on this. And I keep referring to this because this is where people leave money on the table, guys. So always be careful. Keep an eye on the bid and the ask. Okay, so in this picture, I had showed this picture in part 1 also. So any option which has greater than 0 intrinsic value is called an in the money option. So in case of call options, all the strikes which are below the current share price, they have intrinsic value because I have the right to buy the stock at a lower price and go and sell it in the market at the current stock price. So all these are called in the money options. Whereas in case of put options, all the option strikes which are higher than the current stock price, they are in the money options because they are the ones which have intrinsic value. And you can immediately make out, wherever the extrinsic value is lower than the option bid-ask spread, that means there you have intrinsic value. So in case of put options, all these are out of the money options. In case of call options, the higher strikes are out of the money options. And the strike which is nearest to the current share price, which is 160 strike, both for the call option as well as for the put option, these are called ATM or at the money option. And there is also a term called moneyness. I mean, it's not very commonly used, but moneyness basically is an adjective. It basically shows how much deep in the money an option is. So let's say the moneyness of this 180 strike option is much more than the moneyness of the 165 strike option. The moneyness of this 100 strike call option is much more than the moneyness of this 150 strike call option. So it depends upon how much in the money the option is. Sorry, guys. Let me just take a swig of water. Okay, so after purchasing a put option at ask price, for you to make a profit at the time of exiting the option or closing the option, again, I use this interchangeably. You can exit the option or you can close the option. So when you buy an option, it'll be relevant to mention here, we are talking of buying a put option. So it is called buy to open. That is, I opened an option position. I mean, later we will see you can also sell to open an option position. It's something similar to shorting a stock. You can short an option. That is called sell to open. In short, BTO is buy to open, STO is sell to open. So sometimes on brokerage platforms, you might see these terms. So let them not confuse you. And once I have BTO a put option, that is bought to open a put option, I will eventually have to close the option, right? So I can either STC the put option, that is sell to close the put option, or I can exercise the put option. So for me to make a profit at the time of exiting the option or closing the option, I mean, we need to either get a bid price which is higher than what you paid, because remember, when you bought at the ask price. So when you're selling, you'll be selling at the bid price. So your bid price should be higher than the ask price that you paid for you to make a profit, or the intrinsic value of the option has to be higher than what you paid. So one of these two have to be the case for you to make a profit. Of course, I mean, you can always, sell to close an option at a loss. You might have reasons to do that, but, for the option to make a profit, one of these two have to be valid. Of course, there are other advanced considerations. We will not cover them now. Okay, so let's go back to the Carnival Cruises example, which we had seen earlier. Now, on what was the date? This was, let me move this. On 14th of February, the share price was 42.60, and the 40 strike option we saw is $4.40. Now, fast forward to 2nd of March, already COVID is spreading, and the cruise ships have got majorly hit. I think this was the time when a cruise ship, there were some cases on the cruise ship, and it was held up outside Japan. The share price had crashed to 33.06, and see what happened to the put option. The put option which we bought for $4.40, now the bid ask is $10.40, $12. So the purchase price was $4.40 per contract. The current bid price is $10.40 per contract. The intrinsic value, however, as you can see, I can sell it for 40 and the market price is 33.06. So the intrinsic value is $6.94 per contract. So if the put option holder wishes to close the position, it would just make sense for the person to sell the option at market, because by selling, the person will get much higher than what the intrinsic value is. So to sell the put at $10.40, the holder will realize a profit of $10.40 minus $4.40, that is $6 per contract, or $600 on the entire position. Now, look what happened on 13th of March. The world is going crazy. The share price has halved to $17.58. And as you can guess, the put options have exploded in profit. So imagine the person who bought the $4.40 put option, he has already made what, almost 6x of his investment, slightly more than 5x. Okay, the same $40 strike put option. The current bid is $22. However, look at the intrinsic value of this option, 40 minus 17.58, which is $22.42, the intrinsic value, which means if I own the option and if I want to close the position, it does not make sense for me to sell the option at 22 when I can actually realize higher than that. So what will I do? As I have mentioned earlier, I will just maybe buy the stock in one click, and no, I will not have to put up too much money to do that because I already hold this, insurance position, and immediately I can just exercise my put option. So buy at 17.58 plus exercise the put option, which will sell the stock at 40. So effectively, I will end up receiving $22.42 per contract. And I will realize a gain of 22.42 minus 440, which is 18.02 per contract. So on the entire position, I will be making, guys, please excuse me. I know when I gave this example, I was talking in terms of 10 contracts, but now to make it easy, I just changed it to one contract. I should have just, mentioned that. So for one contract, I will end up making a profit of $1,802. Now, taking you back to the payoff diagram, you see here, this is where the share price is, 17.58, and this is my profit, 18.02, right? Because the share price has crashed. So this is the benefit of owning a put option when somehow you know that, maybe the markets will correct. I mean, some people, they are pretty good at making such predictions. I am not. So I, usually don't buy put options. But, just like you don't have to actually go and bang your car just because you have car insurance, right? It just provides you the peace of mind. So put options often play that role. It can provide you the peace of mind. Imagine how blissfully the Carnival Cruise shareholders would be sleeping if they own those put options, at least till the expiry date of the put options. Now let's go back to 2nd of March. So this earlier picture we saw, this is 13th of March when, the share price had crashed. But the 2nd of March, the share price had fallen but to 33.06. And we had seen that, at that point of time, to close the position, if I wanted to close the position on that day, selling the put option for $10.40 would make sense. And I would have made a total gain of $6, that is $600 for the entire position. And this is the $600 profit. So you see these red, blue, and green lines. The red line represents today's payoff. So the point at which the red line crosses the share price, that is where my profit is. Whereas this black line, this is the expiry line. When there is no time value left, that is when this line represents the payoff. So with the passage of time, we have seen that the time value decays, right? So what will happen is the red line will keep moving towards the blue line. You can see the red line is 319 days to expiry. The blue line is 213 days to expiry, so on and so forth. And the black line is the expiry day line, 0 days to expiry. So that is how the time decay takes out the extrinsic value, and the profit will gradually move closer to the intrinsic value of this particular option. So you see the intrinsic value of this particular option was $6.94, right? That we had calculated. $40 is my right to sell, and share price is 33.06. So 694 is the intrinsic value, which is this length. And I had paid $4.40 for the option. So this is the gain in purely from intrinsic value, that is $254. But my current market gain of this option because of the market price is $600. So this difference is basically the time value or the extrinsic value. So this is how it's represented on the payoff diagram. Okay, so what have we learned so far? We have learned that the put option is one of the two types of options. The other one is the call option, which we have covered earlier. A put option contract gives the buyer the right to sell 100 shares of stock at the put strike price, and this right is valid till the expiry of the put. A put option becomes more valuable as the share price decreases, as the right to sell the shares at a predetermined price becomes more valuable. The owner of the put doesn't necessarily need to exercise the put to realize the profit. As the put becomes more valuable, the owner can also choose to sell the put, because the put options are trading in the market, right? All the options, put as well as call. So the owner can choose to sell the put and realize the profit. As the put's market price should include any profit that can be made by exercising the put. Or in other words, the market price should include the intrinsic value of the put. Unless, of course, exercising is a better choice. When the bid does not capture the full intrinsic value, like we saw, for that $15.10 bid. So that is what we have learned so far. Okay, so let's progress. So why not always buy put options along with our stocks if, they can provide us the insurance? Well, everything comes with a trade-off, as you would have intuitively guessed. And this is no different. Let's show that with an example. So you know, on 1st of September, when the markets were at all-time high, this is the stock chart of SPY, which is the ETF, you know, representing S&P 500. So it's at all-time high or close to all-time high, 352.68. So on this day, you know, I think that the market has raced up too much. And I know a lot of people think that, oh, the markets can crash. So let me go and buy a put option. So what I do is I go and buy a 325 strike put option, which is expiring in 29 days, which is 30th of September. And I buy one contract, and to buy this, I pay $246. Okay. And then I go off to sleep. I think that, you know what, you know, even if the markets crash, I have a put option, so that will go up in value. So let's see what happens when the markets actually corrects. Now you see, the markets corrected from 352 to 329.41. So that is quite a significant drop, you know. So you would have expected the put options to go up in value. Sorry, I went ahead. Yeah. So you would have expected the put options to go up in value, right? But look what happened. What I purchased for 246, by the way, this particular option is a 325 strike option. So this does not have any intrinsic value yet. But even the extrinsic value has not gone up. It has actually gone down. You know, 246, it became like 240, 244. So if I want to sell this, I will only get 240. So why did that happen? Because now I have fast forwarded the date to 23rd of September, which is just yesterday. And this option has only 7 days to expiry. So you remember the time decay curve? And that is what has happened. That this is entirely time value or extrinsic value, and this has decayed. So even though the share price has gone down, you know, giving an upward push to the value of the put option, but the time decay gives a downward push. So you see this red line has moved further closer to the expiry line, and we still have a loss. Now, instead of, you know, instead of paying $2.46, what if I decide to buy a cheaper option? I say that, you know what, I want insurance, but I don't want to pay $246 for the insurance. So I will go further out of the money and I will buy a $300 put option. This is equivalent to, you know, let's say you have a medical insurance, but you have decided to take a deduction. So while you have an insurance for $1 million, you say that, you know what, the first $50,000, you know, I will pay from my pocket. So I will only insure myself, you know, for $950,000 instead. And even if there's $1 million hospital bill, you know, God forbid it doesn't happen, but, you know, at least for $950,000 you're safe. So you pay much lesser for that insurance. So similarly, you pay much less for a 300 strike put option, 108. And let's see what happens on 23rd. You see, that put option lost almost its entire value, because again, that put option is also out of the money, but it's far out of the money. The moneyness is much lower. And this is the extrinsic value we are talking about. And you remember I mentioned the extrinsic value reflects expectation of the market. So even though the stock price started going down, the market is not really expecting it to go down so far below that this 300 strike option becomes in the money, you know. I mean, imagine sometime back in March that had actually happened, but right now the market is not expecting that to happen in the next 7 days. You know, that's how it happens. So the put option lost completely all its value. So this is the downside of buying a put. So you can't just think that, hey, you know what? Yeah, I have a stock portfolio. Let me just go and buy some put options. That way I'll sleep in peace. No, because while, yeah, you can sleep in peace, but don't forget that this is eating into your returns. So this is not about just buying one put option, right? This will expire in 7 days. So if I want to continue sleeping in peace, thinking that only buying a put option or buying an insurance can allow me to sleep in peace, I'll have to again spend for this. So like this, over time, it completely eats up into our return. So it's not about buying a put and profiting just once. That might be purely due to luck. For example, the guy who had the foresight of buying the Carnival Cruises put option. I mean, the COVID was hitting, but he or she did not have any idea that it's going to become a pandemic, right? So it has turned out lucky. It's a lucky position for him. I mean, though he might, try to brag on social media saying how smart he is, but it's mostly luck. So it's not about just profiting once, it's about being profitable over time, which would need us to correctly time the market corrections consistently. And that is practically impossible. It's very, 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 very difficult. It just doesn't happen. What can happen is if someone is really smart, like say Nassim Taleb, you know, and he goes and buys far out of the money put option, he pays very less for the extrinsic value. This is like buying insurance when there is no demand for insurance, and he's happy to lose money on his put options for a long period of time. But suddenly, boom, a COVID crash happens, and his put options deliver explosive profits. Something like, like if someone had a put option during the March correction, what this would have delivered, right? Like what happened to the Carnival Cruises. But otherwise, it is practically impossible to consistently make money. I mean, of course, you can integrate buying a put option with other strategies, and you can come out a winner, but just keep this in mind. Okay, so if it is impossible to make money buying a put option, then why did I waste your 1 hour telling you about put options? Okay, before getting into that, let me give you another lesson, which is always ensure you are not overpaying for the extrinsic value of an option, be it a put or be it a call. So there are times when buying an option is a sensible thing to do, but always, always ensure that you're not overpaying. So a lot of people messaged me. I think at least 10 people from our community messaged me sometime in March. Hey, Rupam, do you think it makes sense to buy a put option? I mean, I usually never give recommendations, but during that time, I told, all of them that, guys, you will be completely overpaying for the put option because the storm is already, round the corner, so this is not the time to buy an insurance. So keep that in mind. The time to buy an insurance is when no one thinks that they need an insurance. Okay, so if buying put options has these downsides, why not be sellers of the put options, and why not try to think like an insurance company, because that is exactly what an insurance company is doing. So now we will look at the strategies involving selling of a put option. Now, when we sell a put option, when we sell one contract, we take on the obligation of buying 100 shares of stock for a small fee, and that is the premium. So the buyer of the put option has the right, the seller of the put option has the obligation. So the buyer pays the premium, the seller receives the premium, but against that premium, that small premium, the seller is also assuming an obligation. And that obligation is to buy those 100 shares of stock, which the seller might sell to you by exercising the seller's option. So here is the payoff diagram of how selling a put option looks like. So here I sold one contract. Okay, this is on Facebook. So on 21st of September, which is just a couple of days back, Facebook share price was 248.15, and I went ahead and sold a 220 strike put option. And I will soon explain why I sold it. Now, by selling that 220 strike put option, I managed to bring in a premium of $8.81. Now, you can imagine that by doing this, the maximum, okay, sorry, I think there is a slight error here. I think I went and, change the figure or change the date, because this entry credit should have been $881. So maybe I picked up a wrong figure. So please read this as $881. My apologies. So by selling this one put option, I'm bringing in $881 of premium. But what happens if for some reason, and this put option is expiring in 60 days, which means that this is an out of the money option, which means if Facebook share price stays above $220, then the person who purchased this option from me, I mean, that option will not have any intrinsic value, right? So that person will have no incentive of ever exercising the option. I mean, why would that person sell Facebook shares at 220 when the Facebook shares are above 220 in the market? So what will happen is, if 60 days pass, as we have seen, that the option price will decay and this option will expire worthless. So imagine I sold this option for $881 and the option expires worthless. When that happens, my obligation vanishes. So I get to pocket this $881 and I can go and sell another option. So this is a great way of bringing in a cash flow. But again, before you start jumping in excitement, again, there is a trade-off, right? I bring in that cash flow, but I also assume the risk. Today, if Facebook goes to zero, whether it happens or not, we'll discuss later. But if Facebook goes to zero for some reason, I'm assuming the entire risk of purchasing Facebook stock at $220. So I will be on the hook for $2,200 minus the $880 which I have brought in, which is in my pocket. So that is the risk which I'm taking if I'm purely looking at this as a short-term trade. Okay. However, what if we have researched the Facebook business and we really understand the business very well, and what if we are very happy to buy Facebook at $220? In fact, you know what, guys? I'm actually very happy to buy Facebook at $220. And the reason you're seeing this 881 here is because this is an actual position which I just opened on the 21st of September, because my thinking is this. First of all, I have studied the business. I really like the business. I have a reasonable idea of the intrinsic value of the Facebook business. And I think if I'm able to buy Facebook at $220 in 60 days time, that will be a good purchase because my sense of Facebook's intrinsic value is higher than that. So that's the reason I'm actually happy to take this obligation. Because for me, this obligation means that if Facebook stock price actually comes down below 220, only then the buyer of the option will exercise the option, right? And only then I will be forced to buy Facebook at 220. So which is a good outcome for me because I wanted to buy Facebook at 220 anyway. And now I can't because the share price is higher than 220. So either my objective of owning Facebook at 220 is being met, or I get to pocket this $881, which is also a good thing. So that is our way of looking at selling an option, unlike a trader who would be selling that option and assuming a risk, because that trader does not have the intention of actually buying the shares. Okay, now let's slightly digress and let's talk of a model portfolio. Let's say I have a total portfolio of $100,000, and sorry, my cursor is very sensitive. $100,000, and 60% of that portfolio is invested in stocks which I really like, and I expect to receive, and this everything is long term. Nothing that we discuss here is short term. So I expect to receive a long term return of 15% CAGR from my stock portfolio, and the balance 40%, that is $40,000, I'm sitting on cash because I'm, waiting for stock prices to go down even more. Like, for example, I want to buy Facebook, and, Facebook share price is higher, and I'm waiting to buy Facebook at $220. So I have kept the cash aside. However, please understand that I have no control on the short-term mood swings of Mr. Market, right? I have no idea whether I'm going to be able to buy Facebook at 220. And if I'm unable to deploy this cash is generating 0% CAGR. So even though my stocks are generating 15% CAGR, my combined return on my entire $100,000 in a 5-year period is less than 10%. So that's, not satisfactory for me. And that is happening just because I'm sitting on so much cash, which is not generating any return. I mean, nowadays, you don't even get any interest. So here is our solution. Rather than looking at this as a risk, here, sorry guys, I mean, the figure is $22,000 minus 881. So you can just calculate. So now, rather than looking at that as a risk, look, I was ready to invest that money anyway, right? And, I'm a long-term investor. I don't care if in short-term, the share price goes up and down because of market emotions. I want to own this business for, who knows, 5, 10, 15, 20 years, So for me, this $881 is actually a return which I'm generating on my $22,000 investment for a 60-day period, right? So even though Facebook does not come to 220, even if I don't get assigned the stock, at least my cash is not sitting idle. I consider, when I'm selling this put option, I will keep the $22,000 aside, because my assumption is that I will get the shares, so I'll need that money, right? I'm not going to do stupid things with that money. And to me, I look at this $881 as a return I'm generating on that $22,000. So that's actually a pretty good return. So by doing that, what I'm doing is I'm pushing up the return that I'm generating on this idle cash. So that is no more 0%. And in turn, I'm also pushing up my overall return, which I'm generating on my overall portfolio. So that is the benefit of, this particular strategy. And here, I don't worry about the short-term market crash. Let's say, you might be thinking that, okay, if you get assigned at 220, you end up buying the stock. What if Facebook share price goes down to 160 after that? I mean, guys, that could have happened even if I directly purchase the stock from the market at 220, right? So that has got nothing to do with these options. Because I want to purchase the share, I'm not leveraging, I'm not going overboard. I have kept my $22,000 aside. So, for me, if the stock price goes down even further, I'm a long-term investor, I would probably go and buy even more shares of Facebook, or I can go and sell put options at even lower strike and bring in much more cash. In this particular case, I'll probably just go and directly buy the shares from the market because the shares are well below my expected range of intrinsic value.